The week is about to draw to a close and we open a window at what next week has in store for the markets. In terms of financial releases, we make a start on slow Monday with Japan's annualized GDP rate for Q4, Norway's and the Czech Republic CPI rates both for the month of February. On Tuesday, we get Japan's corporate goods prices rate for February, Australia's business conditions and confidence figures for February as well, followed by UK's employment data for January, and ending the day is the US CPI rates for February. On Wednesday, we note the UK's GDP rate on a month-to-month level and manufacturing output rate both for January, and the Eurozone's industrial production rate also for January. On Thursday, we note Sweden's CPI rates for February, the US weekly initial jobless claims figure, the PPI final demand rate and retail sales rate both for February, and Canada's manufacturing sales for January. Lastly, on Friday, we get the US industrial production rate for February and the US preliminary University of Michigan sentiment figure for March. The USD is about to end the week lower against the euro, the JPY and the pound in a sign of a general weakness. On a fundamental level, we highlight the recent news regarding commercial real estate loans, which appear to be causing concern among economists regarding the resilience of US regional banks. On a political level, we note that the markets may be preparing for a Trump versus Biden rematch in November, following the dropout of Nikki Haley on Thursday. On a monetary level, we note the concerns about inflationary pressures remaining entrenched in the US economy, reiterated by Fed Chairman Powell during his testimony. However, Fed Chairman Powell did confirm that it will likely be appropriate to begin dialing back policy restraint at some point this year, weighing on the dollar. On a macroeconomic level, we note the release of the US employment data for February later today, which could shake the markets. For the next week, we highlight the US CPI rates, and should they slow down as expected or even more, it could allow the Fed to adopt a more dovish stance, thus weighing on the dollar and vice versa. The pound seems about to end the week relatively unchanged against the euro and JPY, yet stronger against the US dollar. On a macroeconomic level, the UK services PMI figures for February came in lower than expected, implying a slow expansion in the service industry. On a fundamental level, we note the government's annual budget deliverance to Parliament by Finance Minister Jeremy Hunt last Wednesday, which saw a 2% cut in national insurance contributions by employers. Yet, in the grander scheme of things, it may prove to be insignificant to the current economic situation. As such, we turn our attention to what next week has in store for the markets, starting with UK's employment data for January. Should the employment data imply an easing labour market, it could weigh on the pound. Thus, should the data showcase the aforementioned scenario, we may see pressures being exercised on BOE to ease its monetary policy, which in turn could weigh on the pound as well, and vice versa. Furthermore, the country's GDP rate for January is also expected to be released on Wednesday, where should it be implied that the UK economic activity is contracting even further, it could weigh on the pound. JPY seems about to end the week in the greens against the US dollar, slightly stronger against the euro and relatively unchanged against the pound. We note that on a macroeconomic level, Japan's Tokyo CPI rates for February, which was released on Tuesday, appeared to confirm last week's BOJ core CPI rates regarding the persistence of inflationary pressures in the Japanese economy. Furthermore, the average cash earnings rate on a year-on-year basis accelerated to 2%, which was higher than expected, and appears to be in line with the BOJ's ambitions of an increase in real wages before potentially abandoning its ultra-loose monetary policy. As such, on a monetary level, with the bank's inflation target now seemingly in sight and an apparent increase in real wages also now in play, potential exit from its decades-long ultra-loose monetary policy policymakers in the past few days stressed the possibility to start normalizing the bank's ultra-loose monetary policy, and there was also a verbal market intervention from Japan's Finance Minister Suzuki to the yen's support on Thursday's Asian session. Overall, BOJ's intentions were the main factor supporting JPY in the past few days. The euro seems to be on track to end the week in the greens against the dollar, yet low against the pound and rather stable against the yen. On a fundamental level, we note that the EU Commission President von der Leyen has won the backing of the European People's Party group, which is the largest party in the EU Parliament, to serve for a second term as President of the Commission. Also, macroeconomically, we note the release of the Eurozone's Q4 final GDP rate, highlighting the difficulties the Eurozone economy faces to grow. On a fundamental level, the ECB remained on hold, as was widely expected, yet in the bank's accompanying statement, ECB staff revised down the core inflation expectations to 2.6% for 2024, 2.1% for 25, and 2% for 26, scoring a win for the ECB's doves. Furthermore, during the post-decision press conference, ECB President Lagarde had to clarify to a press member that she did not say there was no rush when referring to cutting interest rates. However, at the time of the comment, the markets appeared to have glossed over the possibility as the common currency continued on its ascent. AUD is about to end the week high against the US dollar, recouping with interest last week's losses. On a fundamental level, we note that the Aussie's commodity currency nature tends to make it sensitive to market sentiment. The Aussie may prove particularly sensitive to developments in China. Furthermore, given Australia's close economic ties with China, the Chinese trade data for February vastly exceeded expectations, implying that the Chinese economy may be recovering and is expanding. In turn, an apparent expansion in China's economy could lead to increased demand for raw materials from Australia, which may further support the Aussie. Moving on to a macroeconomic level, Australia's GDP rate for Q4 on an annualized basis came in higher than expected, implying a wider than anticipated expansion in economic activity in Australia, which in itself appears to have supported the Aussie. Lastly, next week's highlights for Aussie traders may be the business conditions and business confidence figures, both for the month of February and Tuesday, yet they may have a minimal impact on the Aussie, as other economies may have impactful financial releases in the upcoming week. The Loonie is about to end its 9-week losing streak against the US dollar. On a fundamental level, we note the sensitivity of the CAD to the market sentiment as a commodity currency. The positive correlation of the CAD with oil prices appears to have diverged once again, despite Canada's status as a major oil-producing economy. Nonetheless, on a macroeconomic level, we would like to note that Canada's employment data for February is due to be released later on this afternoon. On a monetary level, we highlight BOC's interest rate decision, in which the bank remained on hold, as was widely expected. In the bank's accompanying statement, it was said that the Governing Council wants to see further and sustained easing in core inflation, implying that the bank may not be preparing to cut interest rates just yet, as it may require more convincing from financial releases. As such, the bank's accompanying statement, in addition to BOC Governor McClellan's comments, may have been perceived as hawkish in nature by market participants, which in turn appears to have provided support for the Loonie. Overall, in the coming week in the FX market, we expect some volatility as high-impact financial releases are still being released. On the other hand, US stock markets appear to be ending the week in the reds. Nonetheless, we highlight that the release of the US employment data later on today could easily change the current trajectory. Also note that the earnings season seems to be over and may continue next month. Furthermore, gold formed new all-time highs during the week. Moreover, the continued decline of US yields tend to support the non-interest bearing precious metals price. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
Hello everyone, my name is Emily and welcome to another of our great educational trading videos. Today we're going to look at day trading. Day trading is a very popular short-term trading strategy that involves the buying and selling of financial instruments during the trading day in order to make a profit from small price movements. The most important rule of day trading is that traders need to close out all their positions at the end of the trading day. Generally, the day trader aims to take small profits that can add up during the day or trading period, while at the same time minimizing their losses. While day trading is a viable trading strategy for many experienced forex traders, beginner traders could find day trading to be challenging. Without a well-defined trading plan and the discipline to adhere to its rules, beginners might be overwhelmed by the stress of intraday trading. Day trading strategies can differ from longer-term trading strategies as they focus more on profiting from shorter-term movements in the market compared to moves that take place over a number of days or weeks. In this respect, day traders need to be continuously focused as markets can move suddenly in the short term. Overall, advantages of day trading include instant results and no overnight risk. On the other hand, the disadvantages include requiring a high initial deposit to make substantial profits, less time to think, and there is also a risk of overtrading. Thank you so much for watching us today, guys. Bye.
Okay, thanks for waiting, everyone. Let's go ahead and get started. So, first things first, a risk warning as per usual. Our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so I'm Melanie and I will be your speaker for today. I'm an investment analyst from Everest Fortune Group who are finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, so here's our agenda for today. So we're just going to get right into chart patterns, looking at the top 3 reversal chart patterns and the top 3 continuation chart patterns. And then we're going to look at how we can incorporate them into a strategy. If we have time after that, which we probably should have, we'll then do a recap of Fibonacci and market structure, because then that leads us into other types of patterns, such as your harmonic patterns and your Elliott wave patterns as well. So we're just going to add a bit of bonus for this webinar as well. So if you have any questions throughout the webinar, feel free to let me know in the chat. And yeah, let's go ahead and get right into it. Okay, So what exactly are chart patterns? So chart patterns are visual representations of historic movements in financial markets. So in your stocks, currencies, so like your forex, commodities, so on and so forth. And these patterns are used by traders and analysts to make predictions about future price movements. So the patterns are the distinct formations that's formed by the movements of security prices on a chart, and they serve as the foundation of technical analysis. So a pattern is defined by a line that connects common price points such as closing prices, highs or lows over a specific time period. So technical analysis and chartists look for patterns in order to forecast the future direction of a security's price. So these patterns can range from the simple to complex, such as double head and shoulders formations. So let's now look at the top 3 reversal chart patterns. So these chart patterns basically indicate that there will be a reversal in trend. And of course, you would know that there are a lot of different ways for you to identify a trend reversal. But these chart patterns are our top 3 ways. Of course, you should use these not on their own, but also in combination with other technical analysis methods. So like your indicators, your moving averages, MACD, so on and so forth, or even your support and resistance levels, Fibonacci. Yeah, so if you manage to get a confluence area, which means there are multiple indicators that tell you that a trend is reversing, that's a bonus, and it's more likely that what you expect would likely to happen. So firstly, we have a double top. So a double top is a chart pattern where the price reaches a high twice, as you can see from the image that I've shown here. So we have one top and two tops, and it fails to break out higher during the second attempt. So you can see that it reverses off of that same swing high resistance. So the pattern comprises of two peaks of nearly the same size and a bottom between them. So the bottom would just be this valley area over here. And then the neckline is where we measure that support level from the bottom of that valley, I mean. So the line running through the tops is the resistance line, which should be nearly horizontal. And the pattern forms an M shape and is considered a bearish reversal chart pattern. So the pullback between the two highs should be moderate. So the pullback is just over here. And the new minor support level is then called the neckline or the support level. And then the pattern is confirmed once the price breaches the low of the pullback between the two highs. So basically, once it breaks out of this neckline area or the swing low support over here. Okay, so I've also included a candlestick formation of what I'm talking about here. So you can see based off of the chart, we have two swing highs that are about the same, or rather it's about horizontal. And then we have the valley that I was talking about earlier, which forms our neckline. And then eventually when it breaks out of that neckline, which means just over here, this area here, then that's our double top formation, or rather double top confirmation. Okay. Next, let's take a look at double bottom. So a double bottom is a chart where the price holds a low 2 times and fails to break lower during the second attempt and instead continues higher. So yes, you can kind of say that this is the opposite of a double top. So the pattern is characterized by a distinct drop in price, followed by a slight reversal or bounce, with a second drop occurring soon after to either the same or similar level as the first before another. Significant reversal so that the chart appears to take on the form of the letter W. So kind of opposite of double top, we have the neckline, instead of being on the bottom, it's on the top. And then instead of having two tops, we have two bottoms. The double bottom confirmation, similarly to double top, happens once price surpasses the neckline. Okay, so the double bottom reflects very strong levels of support, as you can see here. Okay, strong levels of support often indicates a strong change of trend. So that's why you can see once we see price breaking out of here, we can then assume that price has reversed and we're expecting price to continue upwards instead of continue to hit this strong support level here. So double bottoms appear in a downtrend and reverse it to the upside as price breaks through the resistance line. So in this case, our resistance line is the neckline here. So once again, I've included a candlestick example for you to take a look at. Our double bottom has these two, I was gonna say heads, but in this case, I guess they are kind of swing lows in this case. So our swing lows also form a almost horizontal or horizontal level, and that's kind of what you're looking for over here. It's okay if it exceeds by a little bit, as you can see from our example, but it should be approximately horizontal for you to take note of it. So you can take note of the entire length of the wick and you don't have to just measure it from the body of the candlestick. And then once price breaks out of this neckline or this resistance level, then we can say that there is a double bottom confirmation. Okay, so far pretty straightforward patterns. Next, let's take a look at heads and shoulders. So this is also pretty common. And the head and shoulders is a chart pattern that's described by three peaks. The outside two are close in height and the middle is the highest. So it's a bearish reversal chart pattern. And this begins with an uptrend with two higher highs. So you can see from the example here, I have the higher highs here would be number 1 and number 3, and the two higher lows. So the two higher lows here will be 2 and 4, and these form the left shoulder and the head. So the left shoulder is here, the head is here. 0.5 over here makes a lower high, which is lower than points 3 and 1, and this forms the right shoulder. Okay, and the downward confirmation occurs when price breaks out of this point number 6 here. So we have higher lows from 2 and 4, and that's where we can draw our line across. Once price breaks out of here, then we can say that there is a confirmation that there is bearish reversal happening here. Similarly, I've included a candlestick example here. So same thing, we have, if you implement this diagram onto our real life example on our candlestick chart, 0.1 would be here, 0.3 here, and 0.5 here. So if I were to draw or to measure out a horizontal line, well, it doesn't have to be horizontal, just a line that extends out of connecting these two swing lows. Okay, so if I extend it out, once price breaks out of that line, then we have confirmation that price is going to continue lower. Pretty straightforward. Let me know if you guys have any questions, of course, but yeah, pretty straightforward so far. Next, let's take a look at the top 3 continuation chart patterns. So the previous 3 we looked at were for reversal purposes. Now we're going to see how we know if price is going to continue in its direction. So firstly, we have falling wedge. So all these chart patterns I'm going through now are pretty popular and quite easy to spot on your charts. Later on, when I go through some harmonics and Elliott wave patterns, those are a little bit harder to spot. But yeah, we'll go through those shapes and patterns later on. Okay, so next, let's go into falling wedge. So this is the pattern that I've included here. This is the pattern for you to take note of when you are spotting a falling wedge. So the entry, excuse me, we go for a target that's at least the size of the chart pattern for wedges and rectangles. So in the next slide, we have a rectangle as well. So we go for the target that is at least the size of it. So what we mean by that is, if you take a look at the real life example here, okay, it might be a little bit different from this diagram that I have here, but basically what happens is you have this price moving upwards, and then you have price making lower highs. Okay, so it's making lower highs, whereas our bottom line, or rather the swing lows, if you connect the swing lows, it gives you an approximately horizontal level. Similarly to before, doesn't have to be horizontal, just approximately horizontal is fine. So that would be our stop loss. Okay, once we have this level that we have connected all of the swing highs, that is our entry level, and then we're going in for our take profit or target level would just be slightly above that. So because we're expecting price to break out of this shape, this higher resistance level here. So the upper red line, that's our resistance level, and we are expecting price to break out of it. Because there's a lot of downward pressure that's pushing on this area or this shape, so we're expecting price to break out, and that's why our take profit would be a little bit higher up. So that's why I've arranged the levels in this way for you guys to see. Okay, I hope I explained that properly, but let me know if you guys have any questions. Basically, if you draw out the shapes here, it would connect these three swing highs. If we ignore this area here, because we're expecting price to break out and hit our take profit there. So in the meantime, we'll just look at these three swing highs, connect these levels, and then on our bottom, we have our stop loss, and the stop loss is achieved by connecting the swing lows instead. So we connect the swing lows, that's our stop loss, and then we proceed with our entry. So we go in with our buy entry from this level, and then we see it shoot up to our take profit here. Okay. Okay, if we have time after the slides, we'll definitely take a look at some setups, and I'll definitely take a look at gold. But because this webinar is for chart patterns, so we'll take a look at our slides first. If we have time, then I will take a look at gold. Okay. So our next continuation pattern that we want to talk about is bullish rectangle. Similarly for bearish as well, it's about the same, just opposite areas, or rather opposite direction. So in this case, our bullish rectangle, we have three swing highs, so it doesn't have to be three. If you can see in our example with the candlesticks, it's just a consolidated area in which price is testing the upper boundary and the lower boundary, or resistance and support level. So if you connect this area here, it's pretty easy to spot. It's just about the same length of candlesticks and wicks. So our entry would be the upper boundary, and our stop loss would be the lower boundary. And then we're expecting price to break out of this consolidated area, break out of it, and hit our take profit. Okay, so that's for a bullish rectangle. If we're talking about a bearish rectangle, for example, we can expect our diagram to be the opposite. So instead of price moving upwards, we expect price to move downwards. Same thing though, our entry level instead would be our stop loss, and our stop loss instead would be our entry, or rather our sell entry. And then once we're expecting price to break out of the consolidated area downwards towards our take profit, which would be, of course, lower than our entry level. Okay, so obviously for bullish rectangle, we're going in for a buy, and for our bearish rectangle, we'll be going in for a sell entry. Okay. Next, let's take a look at bullish pennants. So for bullish pennants, some people call this flag shape as well. So yeah, it's entirely up to you what you want to call it, but it's all about the same. So for a bullish flag, we have this shape here. Once again, from all of these shapes, we are basically connecting the swing highs with the other swing highs to form a line, and then we see where those lines connect. Oop, sorry about that. So we connect the lines here, and then we connect the bottom lines as well, and then it should give you this flag kind of shape. Okay, so if we're talking about a bullish flag, price will be moving upwards, and then we will expect price. So price is testing within this consolidated triangle area. So we're expecting price to break out of this area and continue in the upward movement. That's why we call it a continuation chart pattern. So price trend is upwards, price is consolidating in this area, and then if we draw out the connect the areas, connect the tops and the bottoms, then we have this flag shape, and then the next step would be to measure out your take profit. Okay, so your take profit would be, as we mentioned earlier, either the size of the same size of your shape, or bigger. So as you can see here, our shape is, yeah, you can see the size of our shape here. So our take profit would be times 2 of that. So we would measure our take profit over here. Or rather, we would put our take profit over here. Okay, so for a bearish pennant, on the other hand, same thing, just the opposite. Price will be moving downwards. Okay, instead of our buy entry being over here, we will replace it with our stop loss. And then stop loss, we'll replace it with our sell entry. Price will once again consolidate within this area, okay, or within this triangle. Once it's consolidated, we will place our take profit times 2 below that. Okay, and then it'll break out of it and then hit our take profit, hopefully. Okay, but that's just how you use this bearish pennant or bearish flag shape. Okay, so that's actually kind of it for the top 3 chart patterns for continuation and reversal. But I wanted to talk a bit about harmonics and Elliott waves as well. Just briefly touch on it if you missed our previous week's webinars. Okay, because when we're talking about chart patterns, even trend lines, support and resistance, all of that are considered chart patterns as well. So yeah, let's just talk a bit about Elliott wave and harmonics. So before I do that, in order to really understand the harmonics and Elliott wave patterns that we're going to be getting into, I'm just going to do a really quick recap on our Fibonacci, because without Fibonacci, the Elliott wave and harmonic patterns really don't quite make sense. Okay, so we have the different Fibonacci levels here, and if you've been with us for our previous Fibonacci series, we go through in depth the Fibonacci retracement, expansion and extension, as well as projection levels. But for now, I'm just going to briefly go through the retracement levels. So for the negative Fibonacci levels, minus 27.2 and minus 61.8, those are our Fibonacci expansion levels. And then the between 0 to 100 levels, those are considered Fibonacci retracement. And then for the 127.2 and 161.8, or above 100%, those are what we call our Fibonacci extensions. Okay, this GIF here, you can see we are following exactly the pattern, or rather the structure of the market, and that's quite important. So here we show you exactly how to draw your Fibonacci. So for retracement, as you can see from the previous slide, the GIF just follows exactly the shape of the chart. Pretty straightforward. My projection is not showing, I'm not sure why, but I'll show you guys that in a second. Next, if we look at expansions, we're looking for a flash kind of shape. You can see now in this GIF, I'm drawing out exactly this flash shape. Flash or lightning bolt shape, whichever you prefer. So our starting point and ending point for expansions lines up nicely with the head of the lightning bolt. And then for expansions, as I mentioned earlier, we are looking at the negatives. So minus 27 and minus 61.8, if I'm not wrong. So yeah, so we take notes of those levels, and for point 3, it has to retrace at least 50% of your starting and ending points. If we look at our extensions, you can see we've drawn out this Nike tick kind of shape. And that's exactly what we call Fibonacci extensions, the Nike tick formation, because that's what you're looking for. In this case, we have an upright Nike tick, but in the next couple of slides, I'll show you guys examples of inverted Nike ticks and how you can use those as well. For extensions, we are using more than 100% levels, so the 127 and 161.8. Okay, here you can see all the different Fibonacci numbers that we mentioned in our previous slide and how it looks drawn out. So yeah, I think you guys can see for yourselves. Positive Fibonacci retracements are our expansions. Fibonacci retracements are 0 to 100%. Negative Fibonacci levels are what we call our expansions. So more than 100% extensions, less than 0% or negative would be expansion. Okay, so here's an example. I have my Fibonacci retracement. So remember, I mentioned how important it is for us to follow the market structure. So that's exactly what I did here. My starting point here, ending point here, and I'm looking at where price has retraced this level. So this 23.6, 38.2, 50%, these are no longer valid because price has already passed these levels. Okay, instead, I'm taking note of the 61.8 because price has reversed or retraced this level and has reversed off of it. Okay. Okay, here is another example of Fibonacci retracement. Okay, in this case, I'm doing it upside down here. So, oh, am I? No, okay, this is not upside down, sorry. So my starting point here, ending point here. Now I'm seeing once again where my price has retraced to, and I can see my price retraced to the 38.2 level. So I highlighted this level because this dotted line at 32544, it is at this this retracement level, but you can see that price also pulls back all the way to this level here, this swing high. So this is what we call an overlap support. So an overlap support is basically when a swing high lines up with a swing low, and it's important because we can see that price, the bulls as well as the bears both respect this area. So that's why it's important, and that's why I've highlighted it here. Okay, so having an overlap support also line up nicely with a Fibonacci level. That's what we call a confluence area. And so we can probably expect price to reverse off of the area as we can see here. So if you have this and then you couple that with your indicators as well as some of the chart patterns that we've mentioned earlier, then you can see there's a higher chance that your analysis will be correct. Okay, so in this example, we have two Fibonacci retracements. So notice how the big Fibonacci retracement trend line price reverses off the 61.8% Fibonacci retracement level. Okay, so my Fibonacci retracement that I was talking about is here. We have the bigger one and the smaller one here. Okay, so both 61.8, but for the bigger one, my 61.8 lines up with the swing high. Okay, and then my smaller Fibonacci retracement, 61.8 as well, lines up with two swing lows. So this once again is an important level because we see that price has respected this level twice. So it's likely to respect this area again in the future. Okay. Okay, next we're going to get into Fibonacci expansions. So an example of expansion and how it plays out, as I mentioned earlier, expansions, we are looking for a flash shape. So this flash symbol also is applicable for Fibonacci projections. So our starting point is here, ending point here for expansions, and we're taking note of the negatives over here. So firstly, my first point, starting point there, ending point there. Number 3, if you can see here, price retraces up to the 61.8% level. So that is our Fibonacci retracement since it's between 0 to 100%. Yeah, so levels, it respects this 61.8, reverses off of it, and it's heading downwards. And in order for us to project where price is heading towards, that's where our negatives come in. We're expecting price to come down to this negative 27.2, where it could bounce off from support. Okay, and you can see this is the aftermath of that, and that's exactly what happened. Price bounced off and reversed off of our negative 27.2. Okay, it bounced off really nicely. And a pro tip is that price usually comes back to this ending point over here. Okay, why does it usually come back? Because as I mentioned earlier, when we have if I were to extend this level, you can see price has tested this level before as well. So we already have two swing lows that line up on the same support level. Now that price has broken out of it, we can expect price to pull back to that level. Okay. Next, we're going to get into Fibonacci extensions. So we are moving a little bit fast because I want to get into the chart patterns for the harmonics and Elliott wave patterns since this webinar focuses on chart patterns. So I want to quickly get through the Fibonacci recap so that we can get into the patterns. But if you're confused, let me know in the chat. Yeah, but normally we go into that in depth each of these Fibonacci techniques in our Fibonacci series. So you can stay tuned for those, or you can go onto YouTube and take a look at those as well. Okay, so next we're talking about Fibonacci extensions. So as I mentioned earlier, Fibonacci extensions, we're looking for Nike ticks. Okay, so our starting point is the head, starting and ending point is the head of the tick. And then once price, we're looking at this V shape. Okay, so we're looking for V shape, and the tail of the tick should exceed 100% of the head. Basically, it should be longer than the head. That's what makes a tick, right? So the projected level is either the 127 or 161.8. In this case, price has already broken out of the 127, so we are expecting price to hit towards our projected level of 161.8. And you can see that's exactly what happened here, and a reversal occurred, reversed off of this level and headed back downwards. So it's another indication of a reversal. Once again, you use this in combination with your chart patterns, like the top 3 chart patterns I went through previously, your indicators, and you're good to go. Okay, here is a GIF to show you guys exactly what kind of shape you should be looking for when you are making use of Fibonacci extensions. Okay, so we're looking for reactions off of the 127.2 and 161.8. Once price breaks out of the 127, then you can go ahead and assume that price is going to reverse off of the 161.8. Okay, yeah, I just let you guys watch the GIF a couple of times and then we can move on. Okay, so we're watching the reaction of the 161.8. Okay, let's move on. So next we have the Fibonacci projection. And excuse me. So we have the Fibonacci projection, and this tool on MT4 is actually the Fibonacci extension tool. Okay, so ultimately, unlike the other 3 methods that we've gone through so far, this method actually requires 3 points. So we need the starting, the middle, and the ending point. Okay, so for this technique, we use namely 3 percentages: 61.8, 78.6, and 100%. But if you're using Elliott wave, we also make use of the 161.8. Okay, for Fibonacci projection, similarly to Fibonacci expansion, we are also looking for the flash zigzag kind of shape or lightning bolt shape, as you can see from this GIF here. Okay, so our starting point here, middle point here, ending point here, we're projecting where price will react off of. And we can see price has already broken out of the 61.8, 78.6, and that's why we can assume that price will reverse off of the 100%. Okay, let's just watch the GIF. Okay, so not included here is the 61.8, 78.6, but we're watching it play off of the 100%. Okay, and you can see it reached 100% before reversing off of it. Okay, but something I wanted to mention is that you can see that the wick of the candlestick was just nice touched our 100% level, which is why it's important that you take note of your trade management strategies as well. You want to make sure that you remember not to put your take profit exactly at your Fibonacci levels or exactly at your confluence areas when you're using indicators, so on and so forth. And that's because price might be, it's attracted to these levels, but it's also likely to reverse off of them because of the huge confluence area. So something that we recommend normally is to place your take profit before the level or before a confluence area, basically before where you expect price to hit. And then for your stop loss, you want to make sure that you place it beyond it. So in this case, we would place our take profit higher up above our 100%, just in case price misses it by a little bit, at least we would have caught that this reversal. Okay. Okay, let's move on. So here's another example. I'm not sure why all of my titles are covered, but here's an example of the Fibonacci projections. So you can see clearly the starting, middle, and ending points here. And these follow the swing highs and the swing lows of price. So it's important for your Fibonacci trend line to follow price movement or market structure really closely. So price has also bounced off of the 100% Fibonacci level over here. So you can see this is our shape, our flash shape, and we're expecting price to go down towards our 100%. You can see it reversed off nicely. Okay, another example. We have a very obvious zigzag or lightning bolt shape over here. So you want to take note of the Fibonacci trend line following the market structure closely. And also we have the 78.6% Fibonacci extension. So because our expansion and our projection use the same shape, more often than not, you can use both together and find confluence areas. Okay, so you can see price really bounced off of our 78.6. One more example for you guys. Starting point, middle point, ending point. You can see the shape here. 100%, we're expecting price to hit it. And you can see it reversed off of it nicely. So an invalid Fibonacci retracement occurs when price makes a lower low. Okay, so if there are bars on the right that break your ending point, it becomes invalid. So I'll show you guys what I mean. So this is what we mean. Bars on the right that break out of this lowest point. So because this is no longer the lowest point, it cannot be your ending point. Okay, so we always want to remember to pick the lowest point with nothing on the right of your ending point. So just, this is a bad example to use for a Fibonacci retracement, basically, because price has already broken out of it. Okay? Yeah. So as I mentioned earlier, market structure is really important. You want to make sure that your swing highs and lows are significant levels so that they're good points to use for Fibonacci. And yeah, this is the kind of structure that you want to look for when you are looking for Fibonacci levels, or even when you are doing your analysis, your technical analysis. Okay, I'm just gonna skip through those and get right into pattern identification. Okay, so we mentioned earlier a couple of M's and W's, but we have a couple more patterns just briefly to go through with you guys. So for these lean more towards the harmonics patterns because they're more complex and a little bit more technical to understand compared to the top three patterns that we went through earlier for continuation or for reversal. So you can see instead of our simple M, we also have extended M's, short formed M's, instead of the simple W, as we mentioned earlier, which would be our reversal patterns. We now have extended W's and short form W's as well. So they're just slightly more complex to understand, but once you do, they can be spotted really easily as well. So all primary harmonic patterns are 5-point patterns with points X, A, B, C, and D. So similar to what we talked about earlier, we have points 1, 2, 3, 4, 5, and 6. Here we have X, A, B, C, and D. So price swings between these points are interrelated and have harmonic ratios based on Fibonacci, which is why we went through Fibonacci really quickly earlier on. So this is because Fibonacci ratios help traders in defining precise turning points in these patterns. So it tells you exactly where you can expect these swing highs or swing lows, or the neckline points that we mentioned earlier that can be used as your entry and exit points. Okay, so we went through a couple of M&Ws earlier, so I'm just gonna move on to show you guys how to identify some patterns. So here are some variations of our M and W points. The breakout points, as we mentioned earlier, happen once price has broken out of the neckline area. So even though it's slightly different, uses a little bit more Fibonacci tools, but ultimately the theory behind it is about the same, or how you use it is about the same. So breakout or upside confirmation basically occurs when price breaks out of this neckline area. If we're talking about a M top, breakout or downward confirmation happens when price breaks out of this neckline. So pretty similar to what we talked about earlier. Okay, so let's talk a little bit about harmonic patterns. So all 5-point harmonic patterns have similar principles and structures, and they differ only by the ratios that are used to identify them and locate their key nodes. So in this case, we have X, A, B, C, and D, as I mentioned earlier. So I've included the Fibonacci levels as well, just for your reference. So from point A to C, it uses 38.2 to 88.6. X and B 61.8, X and D 78.6, and B to D uses more than 100% levels. But that's just for your reference. 5-point harmonic patterns have a critical origin at X, followed by an impulse wave, which is XA. So just the blue line here. So these are followed by a corrective pattern wave to form the EYE of the pattern. So this is at B, okay, completing the AB leg. Then followed by a trend wave at BC, which is another blue line here. Then the ignore this line, and finally completed at the corrective leg, CD, and we call this the potential reversal zone. Okay, we call it that because we're expecting price to break out of this neckline area in order to give us downside confirmation. So it's, even though it looks a little bit more complicated, it's basically about the same as we talked about earlier. Okay, here is how we use Fibonacci in this case. Possible pattern formation is identified after the first 3 legs. So XA, AB, and BC. Then we see where exactly we can place our entry level. Normally, your entry level would come after this neckline area here, because that's where you get downside confirmation. Okay, the Fibonacci ratio extensions, retracements, and projections are then used to determine the potential reversal zones. All harmonic patterns have a clearly predefined potential reversal zone, and the initiation of new trades should take place in this zone, so over here, and only after price reversal action. So after price breaks out of this B, this B level here. Okay, so a couple of patterns for you to take note of. We have the Gartley pattern. So this is the best known harmonic pattern. So after the wave, impulse wave at XA, the corrective wave, or the corrective leg, sorry, should end at 61.8. Okay, 61.8 retracement of XA. Point C falls anywhere between the 38.2 or 88.6 retracement of the corrective leg of AB, including all harmonic trading ratios that fall between these two constraints. So it can be 50, 61.8, 70.7, 70.6, basically any level, Fibonacci level that's between these two numbers. Okay? And yeah, long positions should be considered after a clear bullish reversal with a stop loss placed below the potential reversal zone. So if we're looking at bullish, your potential reversal zone would happen obviously after this this neckline level here. So your potential reversal zone would happen somewhere here. If we're looking at a sell, it would happen after it breaks past the B level. So anywhere after that. Okay. Next, let's take a look at bat pattern. So this is considered the most accurate pattern. And you can see once again it's pretty similar to your W and M patterns. Okay, just with a couple more Fibonacci levels to take note of. So some main rules of the pattern: AB leg can retrace between 38.2 to 50% of the XA leg. The BC leg can retrace between 38.2 to 88.6% of the AB leg. And the CD leg can retrace up to 88.6% of the XA leg. CD leg, so the last leg, can also be an extension of between 161.8 to 261.8 of the AB leg. Okay, it doesn't make sense now that you are just looking at the shape. It just looks like a bunch of numbers. But when you actually try using Fibonacci levels to distinguish the different patterns, it would make more sense then. Okay, and then for the bullish, of course, it's just the opposite of your bearish. So here's an example of a cipher pattern. So cipher pattern uses 38.2% to 61.8 for XB, 127.2 to 141.4. This is for your AC, and for XD, 78.6. And bearish is the opposite of that. Okay, so here is what a cipher pattern looks like on the chart. So you can see it's a little bit more difficult to identify because you would need to take note of the numbers, but ultimately it's still the theory behind it is still the same. Because after it breaks out of this cipher pattern, then we are expecting it to move upwards after it breaks out of this B shape here, or rather this neckline. Once it breaks out of it, that's our potential reversal zone, right? Then it's going upwards, and we can place our take profit, as we mentioned earlier, 2 times the size of your B. So from here to here, this is your potential reversal zone. So times 2 of that will be here. Okay, remember we want to place our take profit before any important levels. So we probably place it somewhere lower just to be safe, just to make sure that we catch that before the reversal occurs. Okay, butterfly patterns. So butterfly pattern requires a retracement of the impulse leg XA by 78.6. Okay, you can take a look here. So I'm just going through the different types of patterns, but there are a lot of different types of patterns. You could probably Google it. But yeah, I'm just going through the different kinds of chart patterns that you can see. Okay, but I think the most important ones are the ones that I talked about at the start. These are just more for your knowledge. Okay, so point C retraces anywhere between 38.2 to 88.6, as you can see here, of the corrective leg AB. Okay, bullish would just be the opposite of that. Crab patterns. So the crab pattern was discussed and released in 2001. So this is an extreme pattern, and the corrective wave AB should end between 38.2 and 61.8 retracement for the impulse leg of XA. Okay, long positions should be considered after a clear bullish reversal with a stop loss placed below the potential reversal zone. So stop loss would probably be somewhere here. Okay, Remember, the potential reversal zone is basically the area after the neckline area. Okay, bullish sharp pattern. After the impulse wave XA, the corrective leg should end between 38.2 and 61.8% retracement of the impulse leg XA here. Okay. So you can see the arrows. Once price breaks out of this level here, then we're expecting it to reverse. Similarly over here, we're expecting it to reverse. Okay, just some advantages and disadvantages for you to take note of. So they are repeatable, reliable, and do produce high probable setups. And they provide future price projections and stop loss levels as well. And they can be considered as leading indicators. Their trading rules are relatively standardized since we're using Fibonacci ratios. So, and they work on all time frames as well. Okay, some disadvantages are that they are quite complex and technical to understand and master. But like I mentioned earlier, as long as you have the basics or you kind of know what you're looking for, once you master the art of Fibonacci, then you've kind of got it under your belt. Okay. And yeah, that's all I have for you guys today. Thank you guys so much for joining me. I hope you guys found it helpful. And yeah, I will see you guys next week. Thank you guys so much for coming. Have a great rest of your week. Bye, everyone.